Hi everyone, I'm Michelle Tiraborelli from Brompton Funds. Today, Larry Holzenthaler from Nuveen Asset Management will be providing an update on the senior loan market. Larry and his team at Nuveen have a great deal of expertise in loans. Nuveen manages roughly $26 billion in loan investments, including the Symphony Floating Rate Senior Loan Fund, which is listed on the TSX under the symbol SSF.UN. This fund invests primarily in senior secured floating rate loans and uses a moderate amount of leverage to enhance income and total return potential. SSF pays monthly distributions and currently has an annualized distribution rate of 9%. And I'd like to point out that SSF's distributions increased in 2022. So in a rising interest rate environment, the coupon rates of loans have the potential to reset higher and could potentially lead to higher income in the fund and higher distributions. This is one of the points Larry will be touching on today. So Larry, thanks for joining me. Can you walk us through what is happening in the loan market and share your perspective on the investment opportunity in loans from where we stand today?
Sure, absolutely. And thanks for having me, Michelle. So the first thing I'd focus in on, obviously, is we just got through a pretty volatile and unusual and historic year in terms of pretty much most asset classes had significant volatility, whether it was more duration sensitive traditional fixed income assets or even equities, certainly later in the year had some pretty substantial volatility. And so loans, I think some of the attributes of loans were on full display last year. Certainly, being down on a total return basis is not an outcome that investors are ever happy about. But from a relative perspective, loans outperformed really the vast majority of most traditional asset classes, whether equities, traditional fixed income. And so, one of the things that we're going to talk about today is, going forward, what are some of the attributes of loans and how might they be helpful in an asset allocation framework ahead? And certainly last year was a pretty good reminder of, some of the powerful benefits of the loan asset class. And so on the next slide here, you'll see, and we'll talk about some of those benefits a little bit more. So as the name would suggest, senior loans are a form of corporate debt that is unique in the sense that it is senior secured. So typically all of the assets of the issuer, things like property, plant, equipment, accounts receivable, all of the tangible assets, and even things like goodwill, go in to collateralize the loan. And so what that's done historically is it's allowed the asset class to have more optimal capital preservation qualities than you might find as an example. Most investors are familiar with high yield corporate bonds. A high yield tends to be unsecured. It can be senior secured, but loans are very unique in the sense that the entire asset class is senior secured and first lien. So things like recovery value are typically much higher versus unsecured debt. And these are credit sensitive, below investment grade forms of debt. So obviously the higher up in the capital structure, the higher up in the food chain you are, the less risk that you're taking. And that's important. And the second feature of loans that is very unique within the fixed income landscape is that loans, while we often talk about them as a fixed income asset, in reality, the coupon structure of loans is actually floating rate. So instead of having a fixed, 5% or 6%, or I guess these days an 8 or 9% coupon, the coupon structure of loans typically consists of a base rate, either LIBOR historically or increasingly going forward, the secured overnight funding rate or SOFR, plus a spread. So as, risk-free rates or short-term rates move around, whether it's the Fed or a little bit more sentiment, the coupon of loans moves up and down with it. So what that does is it gives loans a de minimis amount of interest rate sensitivity. Last year, if you're talking about traditional fixed income, the vast majority of losses were, again, because of interest rate risk or duration risk. And loans have a very limited amounts of that. So from a diversification standpoint, loans are a pretty unique asset class in the sense that the underlying risk you have with loans is credit risk. They're really almost a pure form of corporate credit risk. But they have a maturity date, they have a coupon, they throw off income. So from a diversification standpoint, loans are pretty interesting in that they have, as you can see, very limited correlation to what I'll call traditional fixed income, things like the Bloomberg Ag. or if you look at, even here, the corporate bond index, again, very limited amounts of sensitivity or correlation. So from a diversification standpoint, the loan asset class is, from an asset allocation perspective, pretty interesting. And so, one of the things, obviously, that this chart here shows you is with the limited duration that loans have, they also have a pretty generous and attractive yield attached. And we'll talk about this in a few minutes, that the yields have actually, as one might expect with floating rate, moved higher. And so the combination, or kind of the ratio of yield to duration, looks quite interesting versus the majority of different options that fixed income investors have. So again, what this chart shows is, in a bit of a different way, that you have a very compelling combination here of yield without taking a lot of interest rate risk. And so on this next slide, just wanted to talk a little bit about, kind of where we sit in terms of the economy, and, kind of where loans fit into the current thinking in terms of kind of our outlook and the economy more broadly. And so, first and foremost, it's really interesting. I mean, we as a firm, we obviously have a lot of data that comes into both our desk as well as our global taxable fixed income desk. And the word we keep using is resilient. As much as inflation has been a fear, earnings, potential rising input costs, the reality is the U.S. economy so far, in our view, remains stable. And in fact, as a result of that, I think that you can't overlook potential future risk by the Fed, that the Fed is clearly, on very stable footing here to continue to battle inflation by rising rates. But for credit investors, a resilient economy is really what you want. And as a result of that, we expect defaults to remain very low. The combination of factors, obviously a resilient economy is helpful, but you also have a very benign maturity schedule, just not a lot of loans maturing in the next couple of years that would typically trigger a default. And fundamentals have improved for several consecutive quarters. And so if you think about stronger operating results, it's put companies in a fairly good position to be able to weather any type of deterioration that you might see in terms of, obviously, floating rate financing works two ways. It's helpful in that it has low duration, but from a company's perspective, your funding cost, your cost of capital is moving higher. And so going into a rising interest rate environment and a potentially weakening economy, which many investors believe, loans are going into it with fairly stable footing. And we'll talk about this more. We've talked about it already, increasing yields. The reality is that most fixed income investors are hurt by rising interest rates, at least with regard to their principal values. But loans really only benefit. And so you've not only had stable principal values, but you've also had rising coupon rates, which has allowed many funds that invest in loans to increase the distribution rates to their clients. And so what you have is we think a pretty attractive risk return trade-off, where you have very attractive current yields today. If you think about the risk profile of loans being, senior secured first lien, you're clearly in a below investment grade, more credit sensitive asset. But compared to equities, again, we saw this last year, loans are going to have less risk. They're short dated, senior secured corporate debt. So they're just not going to move around as much. So the combination of having, equity-like returns from a combination of yield and potential gains, as well as lower risk, we think, lays a pretty attractive value proposition for loans in, not only this year in 2023, but for investors who are looking a little bit beyond. We think the 2 to 3 year horizon for loans looks pretty interesting for investors who kind of understand the facts. And so a few of those, data points are right here. Obviously, from a credit perspective, one of the metrics we typically look at is leverage. How much debt do you have, and then how much EBITDA, or kind of cash coming off the business, do you have to service that debt? And as you can see, as I mentioned earlier, the trend has been positive. We've had, I think it's 6 consecutive quarters of leverage coming down. And so that gives the asset class a bit of a buffer for that number to begin to move the other way. And then the other, thing that I mentioned is the maturity schedule for loans is quite benign. The reality is, as you can see in 2023, even 2024, you really just don't have a lot of loans maturing. And so, in an absence of a bullet payment, there's not a lot that would typically trigger a default, at least for the next couple years, even if you have some deterioration within the operating results of these companies. But it's definitely worth mentioning that there are, as one might imagine in any asset class, you do have risks that you need to be aware of. And one of the risks that we've been pretty vocal about with our clients and potential investors is that you have seen some issuance within lower rated companies. Again, like any asset class, there are kind of better quality loans. There are lower quality loans, even within this below investment grade market. And as one might expect, the issuers that have more leverage, that have less cash flow coverage, that are in a worse financial position today, are likely going to be the most at risk in 3 or 4 quarters if the economy begins to roll over and funding costs and cost of capital continue to rise, or even just stay high for a longer period of time. So that is something that we're aware of. That's something that we think could, as an example, trigger some downgrades within certain names. But for active managers, we think that the current environment is pretty straightforward in terms of credit selection and navigating. But again, from a default perspective, default activity has been extremely low. It's expected to rise. Again, that shouldn't be a surprise. But most people, whether you're talking to the credit rating agencies or the kind of strategist teams on Wall Street, I think most people are in agreement because of the maturity schedule and even to a certain extent just fundamentals, that you would not expect defaults to rise materially, certainly not above the longer term averages. So that's something to be mindful of from kind of an outlook perspective. And so moving on, I know that we talked about this a little bit kind of throughout, but I think from a return perspective, you have to think about loans in terms of having kind of different drivers of potential return. And one of the things that we think is very attractive about the asset class is that a significant component of your return going forward, we believe, is going to come from current yield, which we oftentimes like to call cash on cash. I like that term because obviously what that tells you is that's the amount of cash that you're generating on a monthly, quarterly basis. So this is, as we almost like to say, bird in the hand. This is cash coming off the portfolio. And that number, as you can see, has trended meaningfully higher in recent quarters, to the point where I think one could make the argument that just purely looking at the cash coming off of the portfolio today in a loan investment would be viewed as attractive relative, certainly to historical averages and relative to other sources of yield that can be earned in other asset classes today. And again, this is certainly not a bird in the hand, but looking a little bit deeper at other sources of potential return, if you look at the loan asset class, it has reacted negatively, as you would expect, to, I'd say, a coming off of a very bullish sentiment. I wouldn't necessarily say the sentiment is overly negative at this point, but certainly higher inflation, the Fed's campaign. We haven't necessarily seen that flow through to earnings yet, but I think clearly we're in a bit of a risk-off market. And so loan prices have responded to that. So if you look at the average price of loans today, it's in the low 90s. And that's a very meaningful and powerful number because, as I mentioned earlier, one of the unique features of loans is that they're fairly short dated. So the average life of a loan is roughly 3 to 4 years. So if you think about kind of amortizing that discount of call it 7 to 8 points over a 3 to 4 year period, it can be a powerful driver of potential total return. Now, obviously, the trick with that is that in managers like us need to get the credit selection right. So the question becomes, if you're going out and buying 150 or 200 loans today, how many make it back to par and how many don't? And we believe that if you look under the hood of SSF or you look under the hood of our funds or other good actively managed funds, the reality is more loans are going to make it back to par than don't. So we believe that discount, that discount average in the loan market will be a potential source of additional total return. How much? A lot of that depends on the economy. A lot of that depends on the manager and how well they're able to avoid risk. But we believe pretty strongly that whatever that number is, it's additive to the coupon that you're getting today. So you combine those two sources of potential return, and it can be pretty interesting. And the other thing I'll mention is, I mentioned this earlier, downgrades are sometimes viewed as just a general negative. But for us, one of the things thematically that we're going to be looking at with SSF is a number of situations that we've identified that we believe are going to get downgraded in the next few quarters. We don't own them today, but we're prepared to own them at the right price. And so as we try to think about what are things we can do to offset potential inflation, to add to the total return of this fund without just taking more risk, that's something thematically that we're really kind of waiting for and dotting our I's and crossing our T's. And that's a trend that we expect to play out, not defaults, but just downgrades. And that, again, is just a potential source of return if we can do our jobs and make the right credit calls. And so this is a really great slide. I know there's a lot of numbers on this slide, but this slide really kind of quantifies a concept that I talked about a little bit more generally in the last slide, which is historically, if you're buying loans and this shouldn't be necessarily a surprise, if you're buying loans in kind of a dislocated market where you have, loans trading at a big discount to par like you have today, or a market correction, loans can be a pretty powerful asset class in the sense that, as we always say, stocks can remain cheap for a very long period of time. They're a perpetual asset. So really what you need for a stock to move higher is sentiment to shift, which if you've ever owned a value stock, can take a very long period of time. Loans are a pretty interesting asset in that they have a stated maturity date. And that maturity date typically sits, as I mentioned, maybe maximum 3 to 4 years out. And so if you're buying a loan at 91, 92 cents on the dollar and it matures in 3 to 4 years, that can be a very powerful kind of universe of names to buy into, in the sense that they either need to begin to ratchet back to par or they default. And so if they don't default, it typically creates this kind of tailwind for the asset class. And so what this chart does, if you look through these numbers here, it kind of quantifies that if you're buying into the loan asset class at a spread similar to what you have today, your returns the next 12 months or so are well above average for the asset class. And so again, no period of time is ever the same. Certainly, we're not saying that investors buying today should have some expectation in terms of their 12-month total return. 12-month yield, sure, because that yield is coming to you, off the portfolio. I think in reality, you probably want to be a little bit more patient and take maybe more like a 2 to 3 year view. But just the math is certainly worth noting that, buying into the asset class at these levels has historically provided a little bit more of a tailwind in terms of principal values than we've seen, looking at the asset class on more of an average basis. And so going to the next slide here is one last thing I just wanted to just briefly mention before I get into a little bit more about our team and the fund, which is these loans, as I mentioned, have typically some base rate that is historically has been LIBOR. Going forward will increasingly or going forward will be the SOFR, secured overnight funding rate. But there's one kind of technical feature of these floating rate loans is that they typically have what's called a LIBOR floor. It's a term that often gets volleyed around. And so we wanted to just kind of talk about it just for a very brief mention, which is that all of the loans in SSF and really all of the loans in the broadly syndicated loan market where we kind of our universe are well above their LIBOR floors. And you're clearly seeing that with dividend rates. You're clearly seeing that with the coupon payouts of loans. There is no lag. There's very limited lag in terms of the LIBOR floor creating some mismatch between the payout and actual LIBOR rate. I know we might discuss this a little bit later, but there is always a little bit of a lag in terms of the coupon rate and like the dividend payout on a fund and LIBOR rates, but it's not a function of a LIBOR floor, certainly not today or in this environment. So we just wanted to make quick mention of that, just because it's a term that tends to get, as I mentioned, thrown around from time to time. And so moving on to the next chart, we just wanted to talk a little bit about just kind of who we are and what we do. And one of the things I like to say is I work within what we call our leveraged finance team, which is a very specialized team that focuses on below investment grade corporate credit. And so we are part of a very large organization. Nuveen and TIAA are a $1 trillion plus asset manager. I wouldn't call us a household name in Canada, but within the U.S. we have a pretty well-known and established business. And at the same time, this little leverage finance team, we run at this point about $38 billion of assets. So within the broader T organization, we're quite small, but within the world of leverage finance, that type of capital, $38-40 billion in an asset class or a market that is, certainly smaller than the equity market and smaller than the traditional bond market. We are a pretty major player within the below investment grade market, and loans specifically. Again, you're talking about an asset class that is highly specialized. You have a few dominant large players, and we are very much one of them. At this point, our loan AUM is roughly $26 billion. So if you think about it, within the $38 billion we manage, $26 billion is in loans. So loans, I would say, are the heart and soul of what we do on our team. We have roughly 30 analysts or so, and all of those analysts are coming up with ideas on the loan side. So this is definitely a market where size and scale really matter. If you want to negotiate terms on a multi-billion-dollar loan package, you have to be heavily involved in this market and run real money. And we not only run a significant amount of money, but the vast majority of our money is in structures like SSF, which are either permanent capital vehicles or semi-permanent capital vehicles. So we don't have a lot of AUM one day and then not a lot the next. It's a very stable platform. And so I think that's one of the things that's allowed us to drive the type of returns we have, whether it's loans or other asset classes, is it's a roll your shirt sleeves up business. And we have a lot of people to read credit agreements, do channel checks, talk to management companies, get information from, large banks on the street. And so, hopefully that all goes into giving us a little bit of an edge, not only just delivering data to what we think is an interesting asset class, but doing a bit better than that and delivering some alpha and doing some active management to do even better than the market. And so just a few things I'd mention. I always like to joke, everyone has their kind of funnel slide, and this is kind of our funnel slide. The one thing I'd mention, it's at the top of the funnel here is liquidity. Loans are a really interesting asset class in that you have, companies like, Tim Hortons and Burger King and, very large, well-known entities that have multi-billion-dollar cap structures and generate, multi-billion-dollar, revenue streams. And then on the opposite end, you have maybe not mom and pop companies, but maybe companies that have 50 million of EBITDA and maybe only 200 million of debt. They don't have public debt. They're not a public company. They're not a household name. And we really try to kind of focus on the bigger, more liquid capital structures in any market. We've been doing this for a long, long time, and we've always had a very strict preference for buying larger, more liquid names. And the reason for that is very simple. A loan is just like a mortgage on a house. If the bank lends you money and your house doubles in value, the bank just gets their money back. So the bank is almost entirely focused on not losing money. And we're very much similar. We buy these loans most days, not today. Today we get to buy them at a discount, but most days we buy them at par. And so getting your par back and not losing principal is a lot of how you outperform in this market. So being in more liquid names just allows us to, if we don't like a situation or we're getting negative, it gives us some ability to try to sell it and move out and be proactive. Again, liquidity in our market isn't perfect, but being in some of these more liquid names, we think allows us to stay out of trouble a little bit better. And I'd highlight that now today, this is not the case every day, but today the reality is companies, one of the biggest risks is inflation and how rising input costs can pressure margins. And the reality is that bigger companies have more ability to pass through margin pressure, Burger King versus your local hamburger hot dog stand. Burger King has much more wherewithal to try to mitigate that than a smaller company. And obviously, bigger companies with more access to capital have a much better chance at living through recession. They can issue more equity. They have many more levers they can pull than smaller companies. So we think today more than ever, we like that positioning. And then everything else here, I think a lot of it is things you might expect. We do a lot of fundamental work, reading credit agreements, talking to companies. And I mentioned this earlier, with being in more liquid names, we try to be mindful of catalysts and relative value. So we don't just own things because we like them. We also try to own things that we think we can unlock value. Maybe they're going to get restructured. Maybe they're going to get upgraded, beat earnings, something that may unlock the value a little bit quicker than just waiting for it to mature at par. So these are all things we try to do to add value above and beyond just picking the right names. We try to be active along the way. And so a few things that I'll just mention. This is the SSF portfolio. A few numbers that just stick out to me when I look at our portfolios in general or SSF is, if you think about the number of issuers, we have you see here roughly 240 issuers. So if you do the math and you think about having 30 analysts covering 240 companies, these are companies we know really, really well. We monitor them very closely. We're not relying on outside rating agencies or third-party research shops to tell us whether these credits are good. We trust only our own research, and we like to know other people's opinions, but ultimately we do our own research. And again, I think that's part of the reason that our performance has been what it is. And again, just looking at the discount here, as you can see, it's fairly in line with the overall market. So we not only have a pretty interesting kind of coupon and current yield, but also a pretty meaningful discount that we think can add to the total return. Again, the maturity, which I mentioned earlier, 4 years or so. And actually, this number is typically overstated. I won't bore you with the details, but the reality is companies typically call their loans 1 year before the stated maturity. So that 4.5-year number is really, in reality, a 3.5-year number. Again, it shows the power of buying a loan in 92 that matures in 3.5 years if you can get the credit call right. And then in terms of kind of sectors, issuers, again, what I would mention is that you certainly have good diversification from a sector perspective. We're not going to have a huge position in one issuer, but at the same time, it's kind of a concentrated best ideas version versus what a lot of our peers do is more or less own the index. And this is much more of kind of a best ideas fund. So we really think it's a great balance of having good, strong diversification, yet it's a small enough subset of names that we can drill down really deep and do a lot of ongoing monitoring of these credits to make sure that if something happens, that we're on it immediately versus finding out, 2 or 3 quarters later. And so I think with that, I will turn it back over to Michelle, who I think has some closing comments, and again, happy to take questions as well afterwards.
Thanks, Larry. Before we wrap up, I do have a few questions for you. First of all, with respect to the floating rate coupons of loans, how long does it take for the coupon rates of loans to reset following increases in LIBOR? assuming there's no impact from LIBOR floors. I think you spoke about this briefly. I'm wondering if you could expand on that.
Sure. So a lot of times what happens is the coupon payment that might get made, let's say today, is typically going to reference a LIBOR rate that occurred 3 months ago. So in a lot of cases, what investors will notice is there is a little bit of a lag. If a coupon gets paid today, it's not going to get paid at today's LIBOR rate. It's going to get paid at 1 quarter ago's LIBOR rate. So eventually the money does get paid out, and it can work both ways. You can also have an environment where LIBOR is falling and you're getting paid a higher rate because you're getting paid a 3-month backward rate. So it does require a little bit of smoothing out and a little bit of patience. It doesn't. The good thing is it doesn't jump around month to month. It's more of a smooth kind of process, as all of these loans have separate reset dates. It just typically takes each loan to be fully reset. It can take a quarter plus, a couple months. And so that's something that investors need to be somewhat mindful of, is watching the LIBOR rate day to day sometimes doesn't tell you exactly what your coupon payment's going to look like next week or next month.
Yeah, thanks, Larry. Another question. So SSF has the ability to invest a portion of its portfolio up to 20% in high yield bonds. But the allocation to high yield bonds, I've noticed, has been low recently, less than 5% of the portfolio. Can you comment on that?
Sure. So on our leverage finance team, as I mentioned, we run about 38 billion of AUM, and about 26 billion of that is loans. The other 12 billion is in high yield. High yield corporate bonds are, in some cases, kind of like the brother-sister asset class of loans. They're both forms of below investment grade corporate debt. Today, you don't have quite as many crossover issuers that have both loans and high yield, but you do have a number of them. And historically, 10 years ago, you had a whole lot of them. And so they're very similar asset classes. And we actually are fairly constructive on high yield. As a firm, I think high yield relative to equities, is interesting. You have some convexity, duration, which people may want to add now. But I still believe that the relative value between loans and high yield, if I'm going to go, be active and pick the right names and avoid the parts of the market I don't like, maybe lower quality loans, and be more defensive. We feel very constructive on the relative value of loans versus high yield. And they're both asset classes we know and are near and dear to our hearts. We just think that the relative value aspect of loans for an actively run portfolio, not index to index, is pretty compelling. And also, I think just more broadly, I always like to tell people that the loan market and the high yield market are roughly the same size. They're roughly $1.5 trillion in terms of the amount of corporate high yield bonds, U.S. high yield bonds outstanding, and U.S. Senior loans. But from an investor's perspective, like mutual funds, as an example here in the U.S., the peer group of high yield is 3 times the size as the peer group for loans. So given the size of the actual market, investors have roughly 3 times the amount of high yield bonds in their allocations as they do loans. And I've spent some time in Canada, and I have the same sense that a lot of investors have exposure or more exposure to high yield. So at least just understanding the nuances and the differences with loans, I think, is helpful. It's a market where investors now have all these different things they can look at for income. And, now they have, loans as something that, may not be historically something they've used as another arrow in the quiver, or golf in the golf bag, as people like to say.
Great, thanks. So do you think loans can have core allocation in fixed income portfolios?
We do. I think, kind of expanding beyond what I just mentioned with respect to high yield, I think loans have always been an asset class that people view tactically. You buy it when rates are headed higher, and then you sell it and you move on. And I think that's unfortunate. I think for investors who understand, how this asset class correlates or doesn't correlate with traditional fixed income, how it correlates actually with equities, that actually the merits of a long-term strategic allocation to loans. I know we have a lot of, very large, sophisticated pension fund clients who think very strategically about loans. I think more with, retail and individual investors, they tend to be more of an in and out. And so for investors who, need income, want exposure to an expanding economy over time, but they just want less volatility, the loan asset class is something that we think investors should learn more about. And again, we're happy to help investors try to understand not only the opportunities, but also be unbiased and talk about the risks so that they can manage their expectations with clients.
Great. Thanks again, Larry. And thank you to everyone listening for your time. If you have any questions, we would love to hear from you. You can reach out to myself or your Brompton sales rep or contact us through Brompton Investor Relations.